So you do an exchange for physical to Brinks, Hong Kong, where it's delivered there, and then it just gets onto a truck and is delivered to the Shanghai
Yeah.
exchange, never to be seen again at a 10.5%
With
premium to the trader.
new facilities,
So
right?
it is a Brinks facility in Hong Kong, which is a COMEX facility.
Yeah. Okay.
So you can do an exchange for physical from a paper contract here in COMEX, exchange it for physical in Hong Kong, where it's delivered, and then it's just then brought by truck over to the Shanghai exchange and ain't ever coming back. The same thing has happened with gold.
Month after month, the largest gold deliveries in COMEX history quietly disappeared, over $100 billion in real metal vanishing while the public piled blindly into equities. But here's the twist. Insiders weren't just stacking gold, they were smuggling it east. Through a little-known exchange for physical loophole, gold was funneled to Brinks, Hong Kong, then loaded on trucks to the Shanghai exchange. And once it crosses that border, it's gone for good. The LBMA blames counterfeits. But the truth? The real default already happened, and you unknowingly paid for their escape.
I've been focusing a lot about the LBMA. I think that's where you can see much of the stress. You mentioned record low volume or inventory. We call that the float. The float is what is available for delivery, backing the bars that are, or the paper, that the bars that are backing the paper certificates. They have right now, I believe, about 155 million ounces of silver. That is the lowest volume, the lowest float they've ever had since they started keeping records. This is a 140-year-old exchange. Now, I don't know when they started keeping records, but I do know it's the lowest total since that point. And what's interesting is they admit to trading somewhere in the neighborhood of about 180 to 190 million ounces a day. So they're trading more than the stated float every single day. But David Jensen, who does a marvelous job of analyzing the LBMA intricacies and you know the inside and out of the LBMA, and he says, well, actually, that they have admitted to trading 10 times that amount, as they only post the final settlement numbers the day that would equal 190 million on average, but they're trading throughout the day upwards ends of 10 times that amount, which would mean they're trading 1.9 billion with the B ounces per day, which in this case is almost 15 times the float, 3.5 times the annual global mine supply. This is why they went from a T+1 settlement exchange, where T is the trade day plus 1 settlement day. The third day the bar should be moving to you. So if you own a company that produces and manufactures jewelry all around the world and you have LBMA contracts and you need your silver and gold to make your jewelry, sorry, Slayer, you know, we're going to be 8 weeks delayed because, well, we're the Bank of England and we don't have enough in the way of manpower or trucks right now. That's what they've wanted us to believe for a while. It might be getting a little better, I don't know, but I can tell you that the delays coming out of the LBMA signal to me, in essence, a soft default, where the reason they don't have or aren't able to deliver the silver isn't the fact that the Bank of England can't come up with trucks and manpower. It's that they don't have the bars to deliver when they need to without blowing up the system. But this is something that we're seeing, not just there. We're seeing it in other places too, and we're seeing it in platinum as well. And speaking of the LBMA, before I get to that, and how platinum will spill over, you know, it's funny. The LBMA just came out with a warning saying that counterfeited silver and gold will distort prices by creating artificial supply. I almost fell off my chair when I heard that.
What?
I'm thinking to myself, yeah, so they say beware of counterfeits because this distorts prices and creates artificial supply. Then I'm thinking to myself, but isn't this the same company that sells claims on gold and silver that can't deliver? Doesn't that kind of sound like counterfeiting?
Right.
Or trading billions in unallocated bullion contracts backed by nothing? Isn't that the same thing? But anyways, there was a man, I want to read to you something here. His name is Bruce Ikemizu, Ikemizu, formerly head of Chinese bank ICBC's Tokyo Precious Metals Desk, and now head of the Japan Bullion Market Association. Bruce says that the market may already be broken. He more or less says that London and Switzerland appear to have virtually no physical platinum available for delivery. And he says, it seems that there really is no platinum in loco, meaning location, loco, London, or Zurich. Yet the exchange continues trading nearly 3 million ounces per day, so 1.2 or $3 billion worth a day so he says they're trading 3 million ounces per day of London promissory note cash contracts for immediate platinum ownership and delivery. Something is about to break. You mentioned the 7 or 8% lease rate in silver.
Yeah.
It's 30% in platinum. And he says, paying 30% interest to borrow platinum makes it unreasonable to consider unreasonable to consider just buying it outright, says Ikemuzu. I cannot recall a time when lease rates rose this sharply. So it's 7 or 8% in silver, and it's 30% in platinum. That means if you have to borrow for a 1-month contract in order to cover, you're paying 7 or 8%, or in the case of platinum, 30. Behind the banks, he says, are the actual users who borrow from them. He says mining companies, recyclers, jewelry manufacturers, and industrial users. Now, here's the part I wanted to read to you. The revelation of the frailty of the London platinum market can and will most likely knock onto the other London metals, such as silver, that are also traded at leveraged cash contract promissory notes, thus lifting the veil on one of the biggest market frauds in history. And to your point, silver is now seeing a concurrent surge in its 1-month lease rate to 7%, 1 month for 7%. So yes, and we are seeing an explosion in the exchange for physical, the premium that is exploding. And now it's kind of contracting where it's moving towards backwardation, where just all of a sudden where the front month silver that is available is actually priced higher than the futures, which is abnormal. And that basically says that, well, we don't trust the future. We want it right now. So there's a premium to get it right now. Normally, you pay a premium to get it out in the future, which is the time value of money and the increase in the market. But to get it now is actually more, almost to the point where it's in backwardation, where it costs more than it does out into the future. So the market is all messed up. And then you put that into context with the largest deliveries in COMEX history, month over month over month, in gold and in silver. The silver market is changing. I look at it from a technical standpoint, Jay, right where gold was about a year and a half ago. And I think it's poised to make that breakthrough. It is acting very differently. We don't see those smash downs. It's trading within a range, and then it's just bound to take off on so many factors. This just being one of them, the tightness in the market above us. If you're a big trader and you can say, hey, we can sell a huge amount of silver to deliver it to Brinks Hong Kong, which is a COMEX contract and a COMEX facility. So you do an exchange for physical to Brinks Hong Kong, where it's delivered there, and then it just gets onto a truck and is delivered to the Shanghai exchange, never to be seen again, at a 10.5% premium to the trader.
New facilities,
So
right?
it is a Brinks facility in Hong Kong, which is a COMEX facility.
Yeah. Okay.
So you can do an exchange for physical from a paper contract here in COMEX, exchange it for physical in Hong Kong, where it's delivered, and then it's just then brought by truck over to the Shanghai exchange and ain't ever coming back. The same thing has happened with gold. And so there's a battle for the world's commodities right now. And I think the United States realizes that. I do believe that this administration understands it and is doing, which leads me to something that I think people need to understand. I just read that since June, just since June, Jeff Bezos has sold almost $6 billion worth of his stock. $6 billion. You have Jamie Dimon selling massive amounts. You have the 3 largest shareholders and board members of NVIDIA selling hundreds of millions of dollars worth of NVIDIA, all of them. You have, Warren Buffett on $500 billion with a B in cash on the sideline. You have the insiders, and since June 1st, the industrials have been selling equities at about $2 billion a week. And so they're dumping all of the insiders, and the corporation owners or CEOs with all the stock options are selling and going to cash. At the same time, the retail investor, mom and pa, have the largest allocation to equities in the history of the market, even more so than the dot-com crash, at about 54%. So the public retail is all in and the insiders are moving all out. At the same time, you see the largest deliveries in the history of the COMEX market, month over month over month, where we've brought in over 100 billion in gold and silver since November, that we know of. Now, I would argue that either through the Exchange Stabilization Fund under the guise of national security or by proxy behind Citibank and JP and Goldman, that a lot of this stuff is coming in and it's being delivered through, maybe bought through other exchanges, bought through artisanal miners directly, bought through small miners directly, bought through other places that are not registered on COMEX, like vaults in Switzerland or in Singapore or all around the world. Lots of metal is coming in, and who's buying it? The point of it is, whether it be the central banks on a massive buying spree, which they have been for years now, or all of a sudden the largest deliveries in the history of the COMEX to the tune of hundreds of billions of dollars here, but the public is nowhere to be seen. The public has very little exposure. When Silicon and Signature failed, we added 14,000 clients in 45 days. It's nothing like that right now. Yeah, we are doing some big orders for people who see what's coming, but it is nothing like the volume that we witnessed largely during the pandemic and towards the end with the bank failures, which we're not out of the woods yet. But the point of it is that look at the contrarian indicator. The insiders are loading up and taking possession, taking most of that delivery has come off of COMEX. The central banks are repatriating it from the Bank of England and the New York Fed, taking possession, removing counterparty risk. So the insiders are selling equities and buying commodities and taking possession. The public doesn't own hardly anything in the way of commodities and is loading up on equities. What could possibly go wrong?